Hey everybody, we are back on Note Camp. Thank you for taking time on the previous section to be there. Lots of great questions, lots of great answers. What's really exciting is our next presenter who's got a ton of the information. So you definitely want to pull out a piece of paper and a pen to take some messages with. Obviously, these are recorded so you guys can catch up that when we're done with them later this week and send them back out for you. Topic, but this hour 15 presentation is by our good buddy Mark Gold, formerly of the American Home Recovery Fund, but now of Note.Guru and AssetWorks and NoteWorks. Mark is, God, man, we go back, what, about 4 or 5 years on different things, Mark?
Yeah, about 5 years now, I guess.
Yeah, some of you are familiar with maybe him doing the Shadow Inventory Roadshow, speaking at some of our live in-person workshops and things like that. Mark, you're out of Southern California, so those that are on here, of course, we have people all across the country and all across the world watching us. Even Kazakhstan.
Yes.
Yeah, very good. But what I'm excited about is really so many people get started with one-offs, like you and I both. We got started with 1, 2, 3 notes, and then we really wanted to ramp things up to bigger levels. And that's really what you're going to spend time on today, talking to people how they can really start getting pool financing for their non-performing notes and other assets, correct?
Yeah, and you hit it right on the head. When when I started American Home Recovery Fund with my partners, we started with 3 loans, figured out what to do, and then kind of took it from there. And then we were looking to add in financing early on, 4.5, 5 years ago. Of course, at that time, this was still such a new business that none of the institutional guys really wanted to play, and we really didn't see that happening until 3 years later when that started becoming prevalent. So yeah, you hit it right on the head.
Well, first and foremost, Mark is a previous of our country's great Navy, proud Navy man.
That's right.
We thank you for your service, and we also thank for all those that are out there that are watching Note Camp here that are our past and current military and first responders out there. But what we're going to do, Mark, is I'm going to turn this over to you. I'm going to actually close down my webcam. I'll be listening in as questions pop up from the 300 plus people that we have on here. I'll probably interject, ask a few questions here or there. As long as it's on topic, if it's an oddball topic, we'll wait till the end for questions. How's that sound?
Sounds great.
So without further ado, everybody, the Gold Man, Mark Gold.
Thank you very much again for having me on, Chase. Always a pleasure to chit-chat with you guys and present. Again, this is what we do. I think collectively, we really enjoy kind of spreading the wealth of knowledge that we've kind of gotten over the years since we started in this business. Me a little over 5 years ago, and you 7, 8 years ago, whenever it was. So it's always fun to come on and kind of impart that knowledge. So what we're going to do today is talk about finding financing for your pool deals. We're going to talk about what the current opportunities are now with institutional style financing, as well as private financing that you can use for your deals. And that's for anything as little as 5, 6, 7 loans. You're able to kind of tap into that these days. We're going to talk a little bit about the hardest hit funds update, and we're going to talk about asset management and how that relates to what you need to know as you're dealing with financing and putting it into your debt stack, as they say. So let's jump right into it. Again, Mark Gold, CEO of Note.Guru and AssetWorks. I'm also a founder of the NoteWorks software, which we're not going to talk about today, but we'll touch on it just briefly a little bit later into the presentation. As Scott said, I manage the managing director and co-founder of the American Home Recovery Fund, which was a private equity fund operating nationwide from 2010 to 2015. We were a timed fund, so we exited the space the end of 2015 and moved on to the next phase. Been in the business 25 years as a mortgage banker, so I'm one of those guys that help create these opportunities that we're all taking advantage of right now, so you're welcome. Also, as Scott said, a very proud U.S. Navy veteran, and again, from me to you guys, any other veterans on the call, thanks for your service, especially as next week we're coming into Independence Day. Let's remember, let's remember what it took to get us to where we are today. So thanks again for your service, guys. What we're going to cover today, we're going to talk about financing for your non-performing loans. We're going to talk about collateralization loans for NPLs, and yes, guys, that covers seconds as well, non-performing seconds. So stay tuned for that for sure. We're going to talk about opportunities today in TARP, Troubled Asset Recovery Program, and more specifically the hardest hit funds. We're going to talk about a real case study from our fund and how we tapped into hardest hit funds and how we used financing to kind of get some amazing returns on that. And we're also going to talk about asset management briefly and how it relates to the financing, because again, what you need to really understand first and foremost is that when you're using financing, you're using other people's money, whether it be institutional or private money, and the time is your friend and time is your enemy. So using asset management and loss mitigation strategies to shorten that time frame to be able to get to your ROI, which we'll talk in detail about, is the most important part of the puzzle when you really sit down and look at it. Financing terms. First thing I want to do is kind of briefly go through some of the acronyms. Again, we're a very acronym-rich business, whether it's mortgage lending, distressed debt, real estate as a whole. As we're dealing with non-performing loan financing, especially since it is typically in the single-family home space, whether it be condos, 1 unit, 2 unit, whatever it may be. The terms are a little bit different, and you do need to be aware of them. Whether you bought your residence or you have not bought a residence yet, some of these will be familiar to you. So we just want to make sure we touch on them. LTV, most everybody's heard of, is loan to value. That's the value. That's the number from the property value to what you're actually lending at, as it relates to a percentage. LTI is loan to investment. Okay, now you need to take your homeowner hat off and put on your investor hat. We're investors. How much money are we putting into the deal? So loan to investment amount. LTC is loan to cost. That number pops up as it relates also another way of saying LTI, but also when you're dealing with construction loans, loan to cost. So it's kind of could be fit in 2 ways there. DTI, most everybody's heard of. That's debt to income ratio. DSC, debt service coverage. That's a term that's used most of the times with commercial finance. And again, even though we're dealing with single-family homes, single-family residences, it is a commercial deal because of how it's being structured with us being investors, right? We're not living in it. DSR, debt service reserves. Those are reserves required to service your debt. Best way to put that one. Sponsor is me, it's you, it's whoever's actually buying the assets, applying for the financing. You are the sponsor of the deal. That's whether you have partners, whether you have JV partners, whether you're getting outside investor financing as well. You are the sponsor of the deal. Recourse versus non-recourse. Recourse loans means that you're personally guaranteeing the loan. Non-recourse means that it's an entity, it's being made as a business loan or an entity made to either a limited liability company, a corporation, or any other number of entities that are not a human being as a borrower. Insurance requirements. We're going to talk a little bit about lender insurance, homeowner insurance, or forced place insurance that you want to have as a lender. Very, very important. Here's a phrase you need to understand, because this is kind of what plays into the collateralization loans. It's called hypothecation. Real fancy word. Let's read the definition so you guys got to understand it. It's the established practice of a borrower pledging an asset as collateral for a loan. In this case, we're talking about pledging non-performing loans as collateral for a loan, while retaining ownership of the assets and enjoying the benefits therefrom. What benefits are we talking about? Benefits being, if that non-performing loan becomes a performing loan, we're benefiting from the cash flow. If that non-performing loan becomes REO or real estate owned, we're going to benefit from profit from that. So we are pledging it as collateral. We're still able to enjoy the benefits from that collateral. Should make sense. With hypothecation, the lender has the right to seize the asset if the borrower cannot service the loan as stipulated by the terms in the loan agreement. So same as when you're buying your house, right, guys? Your lender has a right to foreclose on you. In this case, with a collateralization loan, the lender has the right to the collateral if you're not able to meet up to the terms of in the loan agreement with them. That's probably making monthly payments. Here we go.
Uh-oh.
Now it's a Carson show. So same thing as if you're buying a house. There's certain things that you have to do that you're warranting that you're going to do as the borrower or sponsor of that loan. Terms you can expect. Loan term. Typically, we're going to be looking at about a 3-year, anywhere from 6 months to a 3-year term, depending on what the lender, depending on the terms that you're actually able to secure with the lender. Interest rate, you're going to expect to see anything from the mid-single digits up to the 11-12% range. Typically, what we're seeing in the institutional financing is going to be in about the 8-9% range. Points, you're going to pay anywhere from 1.5 to 3 to 5 points, depending on what it is. On the institutional loans, it'll be lower, 1.5 points generally. If you're securing private financing through small private money or 401k investors, self-directed IRA investors, they might be charging a little bit more, but nothing's kind of set in stone as it comes to private deals. Debt service, typically you're going to be making monthly or quarterly payments, interest only. Nobody wants I shouldn't say nobody. Most lenders don't want to sit there without getting some kind of cash flow in from the loan that they're lending you. So a lot of people ask, can we just stack the interest into the end of the loan? Typically not, but again, everything is negotiable, especially when you're dealing with individual private investors. Sources of financing for non-performing loans: friends and family. Everybody's got rich uncles. Most people have rich uncles. Most people know people with 401ks or self-directed IRAs. Again, once you're actually able to get a couple of deals under your belt with hopefully some decent profits, sitting around the Thanksgiving table talking about what you're doing, you never know who's going to want to get involved and get better than that 1% return that they're getting, or 0.5% return from the bank or their CDs these days. Right, Scott, what do you call it? Your
certificate of disappointment.
There you go, certificate of disappointment. Exactly. So, most people, although they're invested like that for the long term, there's much better deals out there. And everybody on this phone, if you on this call, if you've been involved at all, then you know what that is. Self-directed IRAs. Belinda from IRA Trust Services, we work closely with her. There's a couple of great custodians out there, but the number that she's thrown out is $7 trillion in the marketplace for self-directed IRA money right now. That's a staggering amount of money that's sitting, waiting to be deployed. We literally just heard, this past week about the Brexit, right? That's going to, next week, the financial market's probably going to be pretty volatile and pretty explosive. So we'll see kind of how that plays in. But again, people are sitting with their IRAs and 401ks. There's going to be a lot of money leaving those spaces. So again, what that's going to do is want to put people into more secure investments. More secure investments being real estate, right? Whether you're investing in real estate, non-performing loans, or whatever it may be, that is a more secure investment right now. Institutional funds and banks. We got BlackRock, Bank of the Internet. Institutional lenders like that have gotten into the space and are in the space, and as well they've kind of gotten into the space more recently. Bank of the Internet, they've been around for about 4 or 5 years. More larger institutions.
They've been around since 2008, 2009. I remember buying some actually RV loans from the Bank of the Internet back in 2009, 2010.
Oh wow, wow, yeah, they've been around that long, but I think in coming together with portfolio loans, that's something that at least I saw probably 5, 6, 7 years ago. So because they were doing loan originations back actually in 2004, 2005, so they've been around for quite a while. I remember as an originator, they became a pretty big mortgage bank platform, and it's like Bank of the Internet. It's like, where are they? On the internet. So it was one of those goofy deals back then. But they, again, more for the larger. Most of the folks in Note Camp are not going to be dealing with them because obviously they're looking for probably $10 million minimum deals. Where BlackRock is coming into the marketplace looking for the smaller deals and looking to get more of the smaller investors involved. But at the same time, it's a road that has to be navigated carefully. So. Under our AssetWorks banner, we've got a relationship with BlackRock to where we'll be the conduit to help kind of get deal flow structured where you'll be able to get the deal done and put through that avenue. asset works, we just talked about that. Collateralization loans. Think back to what we were just talking about on the hypothecation. That's exactly how this works. So a collateralization loan is typically going to be through a self-directed IRA. So the investor is going to be through a self-directed IRA to where that collateral being the non-performing loans that are being bought, and in this case, maybe it's 1, 2, 5, 10, who knows, again, we can structure it, will be, the collateral will be held through the third-party entity. So in other words, an assignment, a collateral assignment will be held by a third-party entity that gives the lender the right to that collateral that's being held by the self-directed IRA in case anything goes default on that. So again, this works on first and seconds. Think of it the same as a regular loan, except the collateral assignment, instead of having to foreclose on a deal, the collateral assignment is set up in advance so that the lender, should anything go sideways and the terms of the loan are not met, the lender has a defined path to get his collateral back to be able to liquidate. Again, collateral assignment can be with a third party. Asset works as a third party, or an independent escrow company can be used for that as well. Getting ahead of myself there. Terms are up to 2 years, as little as 6 months, again, to be negotiated. These are more private investors that we've kind of consolidated into a network that are making these kinds of loans. So depending on what you as the sponsor needs and what the lender is willing to do, we can kind of figure out what the terms are going to be on that. Interest rates, again, be between 9 and 12%. Points are going to be negotiable. These are made specifically for the self-directed IRAs because those are bankruptcy secure entities. So in other words, if you as a sponsor went bankrupt, your self-directed IRA is insulated from that. So in this case, that's going to be the mechanism for making that loan, because the lender doesn't want to deal with having to kind of go after through the bankruptcy courts like we all do as investors to be able to get their investment back. So it's set up a little bit differently with more favorable exits for the lenders. Hardest hit funds 2016. Let's talk briefly about that. I know over the course of NoCamp, a bunch of the speakers have probably mentioned and talked about some of the statistics for hardest hit funds, how they've used the hardest hit funds to improve and increase their ROIs and knock some of them out of the park, probably same as we did. Originally, hardest hit funds was started with $7.8 billion, part of the Troubled Asset Recovery Program, specifically given to the 18 hardest hit states to help with various things, which we'll talk about on the next slide, to help homeowners avoid foreclosure and stay in their homes. The program end date was supposed to be the end of this year, once they hit 2017. What happened was most of the programs were pretty successful. Let's back up for a second. So each state was given X amount of money depending on what their needs were. California receiving $2 billion, Ohio or Arizona received $700 million. It was all different. And what happened was at the beginning of 2016, an additional $2 billion was put into the system and refunded to the states that applied for additional funds to continue helping their homeowners in their states. And the program end date was also extended to the end of 2020. So that just gave us 3 more years to operate and take advantage of the free government money. Sound effect?
Right, and let's talk about that a little bit. You've got the 18 states plus the District of Columbia. What was funny is some states like Ohio literally shut down their program, laid everybody off, and now they're having to rehire people back to revamp it back up. So it's a little bit of a delay there, but it still makes those states that got hardest hit money just a little extra desirable because it's extra gravy that other states just don't have, right, Mark?
Exactly. And some of the states actually chose not to apply for any more funds. I saw Florida was one of them, did not apply for any more funds for whatever reason.
They haven't used the ones they had beforehand. I mean, the Florida stuff, used to be really hard to get unless you were actually a licensed institution, but now we're starting to say, you can drive through Florida and start seeing all these signs from attorneys that have now specialized in the hardest hit fund to capitalize on it. Because Florida hadn't used half of the $1.1 trillion or billion dollars that was given to them for the most part. Probably billion. So it's still a ton of what's available.
Right. And then also
$1 billion.
right. And then also I had something kind of profound to say there, but I lost it. can't remember what it was now. The anyway, um, let's see. Hardest hit fund programs vary state to state, but may include the following: mortgage payment assistance for unemployed or underemployed homeowners, principal reduction to help homeowners get into more affordable mortgages, help for homeowners who are transitioning out of their homes into more affordable homes. So again, you can see the money was put into place. Oh, actually, what I was talking about before, you said Florida. California, who got the lion's share of the money, we didn't start seeing ads really till about a little over a year and a half ago, and the program had been around since, what was it, 2012, 2011, 2012 probably. But you just started seeing advertisements just from state-sponsored advertisements maybe a year and a half ago. Most realtors out here, same thing, they never even heard of the program, which is Keep Your Home California. So what we talk about in the industry is that the states did a pretty horrible job at letting the homeowners in their states know that that program was there for them. So, okay, so back to this. So we got, so here's how it's put together. Pretty much in various ways, and each state is different. The states were given the money, told here's the general guidelines. You institute the program the way that you need to institute, the way that you see fit. So again, anywhere from, Ohio having a maximum award amount of $25,000 to help homeowners in foreclosure, up to California, which I think the top award is like $125,000 or something like that. So each state had the freedom and the freedom to be able to put it together the way that they saw fit. Great resource on Treasury.gov. That's the actual Department of the Treasury website. If you click on hardest hit funds, it gives you each program's link state by state to, and this is real important for us as investors, right? Because if I'm buying a note or a portfolio of notes, I want to know where I might be able to tap into that money. And you guys will understand a little bit of the power of what this money does for your ROI in a little bit. But you can see exactly what the program entails, how much money they've deployed already, and how much money they have left if they got any in the next rounds of funding from this year. So great resource. Make sure you use it. With that said, who's interested in seeing how to use financing to get a 742% return on a single note investment?
Me.
Well done, Mr. Carson.
There's a lot of hands going up here.
I'm sure there are. I'm sure there are. All right, so this is a deal that we actually bought back in 2012, I want to say. This is actually my first experience with hardest hit funds with our fund. Dana and Michelle in Warren, Ohio. Last name's left off here to protect the innocent or not innocent. We paid $26,000 for their loan. Current value on this was about $68,000, and they owed about $68,000 plus past due amounts. This was kind of a weird one back in 2012, 2011, as Scott is very well aware also. Most of the deals that we were looking at as investors back then, they were two times encumbered what the value of the property was. So the typical deal would have been the house was worth $70,000, they owed $140,000 plus past dues. So this one, we got into this deal, and it was, they had a little bit of a light at the end of the tunnel. Now, they were behind 3 years, so their past due amounts were about just over $20,000, about $21,000 and change actually, and they still owed some property taxes and a couple of other things. So this one was kind of an odd one for us because we were so used to seeing things very, very upside down, and this one wasn't. The cool thing was that they could afford the payment. So what we like saying, and I say this often, is that in this, in the millions and millions of loans that have been defaulted in the last, since the market blew up in 2008, every note and every home has a story. My job is to figure out what that story is and see how I can help keep that homeowner in the home and help them navigate out of that typically bad story. So in this case, my partner and I had we had just started buying in Ohio and Indiana, and we had no real experience buying over there. So we said we need to go get in tune with what's happening in the local markets over there. So we actually flew out, spent a couple of days, drove around almost 1,000 miles visiting all these notes that we were buying, and we had bought about 20 notes in this first big portfolio, actually 25. So we ended up just driving through Ohio and Indiana, looking at the areas, seeing what a $50,000 or $70,000 house in Ohio or Indiana actually looked like, and what was happening in the local marketplaces. So we're driving up this street. I remember it's right before Halloween, a little drizzly, and we pulled up to this one house, and it actually looked kind of nicer than most of the houses that we've actually looked at. So, I mean, it was painted, it was landscaped, it was actually a very nice property. So it pulled up, we actually almost drove by it. And then so drove by because we were looking for the one that was probably falling down and falling apart. So I got out, Brian waited in the car, I walked up to the door, knocked on the door, and heard a ginormous dog start barking behind the door. And then woman comes to the door, opens it up a crack, and she's like, "Hi." And I'm like, "Hi, I'm Mark. I'm your new lender." And so first thing, of course, she says is, "Uh-oh." And I said, "No, this is not an uh-oh moment. This is a hallelujah moment. I'm here. I'm glad to actually talk to you. We want to help keep you in your home. We bought the debt and blah, blah, blah. We bought your mortgage, and, we want to keep you in the home." So she says, "Okay, would you like to come in?" So I'm like, as long as the dog doesn't eat me. So she invites me in, and I sit down with Michelle, and we're talking about probably a good 15 minutes. And again, this goes back to every home has a story, every note has a story. Found out that this was Michelle's grandmother's house from 40, it's been in the family for over 40 years. Her and her husband bought the home whenever it was, 10 years earlier, whatever it was. And so they were very motivated to try to keep that home. The cost had been there. You could tell the pride of ownership was there. They were taking good care of the place. And what the story also told us was that the husband, Dane, was a pool maintenance guy, had a little pool maintenance company. And when the market blew up in 2008, that was some of the discretionary bills that most people in the area got rid of, right? You're worried about putting groceries on the table. You're not necessarily worried about, cleaning the pool skimmers. So his business went down to nothing. She was on disability, and they were basically living off of her disability payments from the state. So again, I think she was getting $1,500 a month, whatever it was. The payment was $606. They were able to afford the payment, but because they were so past due, of course, as we all know, GMAC, who was the original lender and then became Aquin, they would only take payment in full, which now it's 3 months, 4 months, 5 months, up until they sold the loan, probably 2 years into it. So they got put into a spot where they had no ability to kind of crawl out from that. Whoops. Hold that.
You've got to be somewhere, huh?
Okay, how do I get rid of that?
There you go.
That's bizarre.
How bizarre.
Let's see if this pulls us back. Oh, there we go.
There we go.
All right. Some more technical difficulties, right?
No comment, Mark Gold. Technical difficulties exist everywhere.
That's right. That's okay. Keeps it interesting.
Amen to that.
That's right. So again, so sitting there chatting with her, coming into the end of the conversation, we put together a plan. Said, okay, and this is something that I told Michelle, but I would never tell another borrower after I went through this, because there's just certain things you don't tell them. Mainly that you bought their loan at a discount. So I told her, and again, this is my first experience talking with a borrower on the note that we bought. So I told her, I said, okay, so you've got $21,000 in arrears. I heard about this program called the Hardest Hit Funds. Let's have you apply for that. Let's see if you can get qualified. I think it sounds like you might qualify to actually get that. And if you successfully do, then the state is actually going to be paying all the arrearages and amortizing your loan down. And I think the way I figured it out, there should be some money left over to where we can pay your property taxes as well. And then you're just on the road to making those payments again. She's like, okay, great. I said, if you don't qualify, here's where the thing that I shouldn't say. We bought your loan for a discount, so I can make that $21,000 go away just with a swipe of a pen. So she's like, oh my God, that's phenomenal, blah, 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 blah. Now, good thing is, we had her apply for Hardest Hit, and they actually started going through that system. It took a while. It took about 4 or 5 months to actually navigate, again, because of our inexperience and her inexperience, and it's a government program, so though there's some issues with that as well. It took a solid almost 5 months to actually get to the end of the rainbow on that. But now we did get to the end of the rainbow. So let's talk about the economics of the deal, which is what you guys will care about. So for 6 months after I visited her, and while she was working through the process of getting through Hardest Hit, we collected $3,640, which was 6 months of payment at $606. We ended up getting $32,000 from the state for Hardest Hit, which we didn't know about this. It was a $25,000 award, which we paid the $21,000 in arrears. as well as $3,600 or so in the property taxes that were owed. And then they also paid, they forward paid an additional almost 10 payments of the, because again, he still wasn't working, she was still on disability, so they actually forward paid almost 10 of their payments, I think it was. So we got $32,000 from them. Then we were able to refinance them out into an FHA 1023 loan, which if you guys haven't talked about that, make sure you Google FHA 1023 loan. It was one of the best programs put together in this time of crisis, which actually worked for the borrowers that were in default. So we ended up getting $57,763 out of that refinance. Total received of $92,403 on our investment of $26,508. That was a 371% return in 6 months, or 742% annualized. Hallelujah. Who wants one of those?
Bingo, bango, bongo, baby.
Bingo, bango, bongo. Absolutely. That's right. These are the ones that you don't expect. You hope for them, but then you'll get, again, you'll hear lots of stories of people that have tapped into these things the right way. And again, it's not going to happen on every note that you buy, but if you can tap into every 10 deals or every 15 deals and get one of these in there, think about what that does for your return on investment with yourself and your investors and whoever else is investing with you. So pretty cool stuff.
Show me the money.
Drop that mic. All right, let's talk about AssetWorks for a few minutes, or what we like to call the good, the bad, and the ugly. Let's talk about the bad first. Loss mitigation work from servicers are not results driven. All of us that have at least bought a note probably have some horror stories from some of the servicers, which I'm not going to mention any names, just not like that. But servicers that do loss mitigation, typically, you typically get a feeling like they're trying to keep your deal in there forever because they're making all their money from that. So being a fund manager myself, and being involved in buying, selling, brokering probably close to 1,600 loans over the 5 years, almost 6 years with 1 year before that. We've always seen, and that was one of our biggest frustrations, was having to deal with the servicers mitigation department. So again, kind of putting this together from an operator as a fund manager on where the problems lay and where the landmines lay in this part of the business. This is some of the stuff I'm going to be giving you today. Biggest problem is speed of execution, right? We take $10, we invest it into a loan, we just spent the $10. We don't make a dollar until something happens with that loan. The something being it becomes a modified loan. We end up getting a deed in lieu of foreclosure, or we end up finishing a foreclosure and taking control of the property and then selling it as a REO asset. So I think we said a little bit earlier, time is your friend, time is your enemy. So the shorter we can make that window of time from the time we spend that $10 till the time we get back that $20, that's where the magic is made in there. So it's how we do the reach outs, how we do all the different parts of the puzzle on loss mitigation. That's where we really shine on this. Service and collection departments handle way too many files per employee. That's the biggest complaint that we hear in the business as well. They're making 5 calls a week on your deal, and meanwhile they've got 10,000 lenders out there that they're handling 20,000 loans for. It's just you're part of a big wheel that's turning. A la carte fees are insane. I got my first taste of that about 5 years ago when we did a lot with FCI, and one of the things that really irked me with FCI, we wanted to send out a demand letter. We didn't have an attorney on the deal yet, but we were going to send out a demand letter. They wanted $150 to print the form letter. $150, and that was going to be emailed to me and then sent out by me. So again, it's a one-page document. We end up recreating that, like most of you out there probably have as well. But the fees that they charge for somebody that doesn't have the time or the desire to do any of that, they can be pretty crazy. That was a good one. You know what, Scott? You guys should do a radio show. You've got the whole
it's not like I don't do a webinar every Monday night.
Exactly. Oh my gosh.
You wouldn't want me on the radio because like
right.
the Dan Levitard show.
if you're using other people's money, then it's costing you ROI every day. That would, again, that we're dealing with, you know, a subservicing servicer, I guess is the right way to put it. All right, the good. Let's talk about Asset Works, which of course is the good. So again, we're not a servicer. We're specifically concierge, loss mitigation, and asset management. And I just want to briefly run through, there's about 3 slides. I'm going to go through them really quickly. These are all the things that you might not even be thinking about that you need to be thinking about if you're trying to do some of this stuff on your own. So I just want to make sure it's just fresh in everybody's head what's actually involved from the time you buy the loan to the time that you dispose or get to a cash flowing event in that loan. So again, coordinating the delivery of collateral and servicing transfer, onboarding due diligence, exception reporting, borrower outreach, which is one of the most important, and we talk about that all the time. I know Scott does as well. You know, it's all about RPC, or right party contact. If I can get a hold of that homeowner and speak to that homeowner, I can solve the problem. Whatever that problem is, if the problem is solved by modifying the loan, great. If it's solved by giving them a deed in lieu option because maybe they're divorced, bankrupt, and already moved out, and this way they don't have that mortgage hanging over their head again, I'm solving a problem one way or the other. Or if they've just bailed and the property's sitting there, same thing with a live mortgage on it, we could finish the foreclosure either friendly or not friendly, but it all starts with that initial conversation with the homeowner. Early intervention, workouts, referral and timeline management, part of hit fund screening, right? So if you're buying a portfolio of loans, you know, it's a lot of work to figure out if they're going to qualify for the hardest hit funds, and you being able to tap into some of that money. Skip tracing, credit reporting, lender insurance, servicer oversight, tax lien monitoring. Tax liens could be the death of you in this business, right? Because even if, and again, I'm sure there's probably second mortgage investors as well as first mortgage investors. If you're a first mortgage investor, the only way you're going to really lose your investment is by messing up on a tax lien and getting taken out by taxes. That would be pretty bad. That's a conversation you don't want to have with your investors. Asset management, asset valuation, loss mitigation process management, default strategy, title curative. Maybe there's an assignment of mortgage that's missing, an allonge that's missing. You know, these things have to be hunted down and tracked down. Attorney to legally foreclose on a property. Attorney oversight, bankruptcy coordination, foreclosure coordination, post-foreclosure REO liquidation, loan sales, eviction coordination, property preservation, and REO repair oversight. That is a lot of stuff that has to go on, and because of the way that we encompass the whole program, we actually do that for $75 a month for as long as you need that service. So in other words, you buy a note. If it takes 2 months to get to a modified loan, then you're paying for it for 2 months. If it takes a year, you're paying for it for a year. If it takes longer than that, it's whatever. But we're going to actively be doing all of these things on your behalf so that you don't have to worry about it, so that you're worried about looking at the next deal to buy, finding the next investor, you a check to buy that next deal, and keep the process moving like that. So we feel it's a pretty amazing value proposition that we have for the business, especially from a non-servicer perspective, to be able to kind of fill in those gaps for you on that. So pretty cool stuff. So that was the good. Now let's talk about the ugly. There's only one thing on the ugly: making your ROI equal 0. And again, how does that happen? First mortgage lien and you lose it to a tax lien, or buying a loan.
Terrence bomb there.
Just had a flashback. It just froze. I was just frozen in fear.
Yes, ROI 0 does scare the hell out of you.
Yeah, ROI is what ROI equals 0 is the scariest part of this business, right? And again, losing it to a mistake in your due diligence, losing it to a mistake not watching taxes, losing it to a mistake by taking, having a thin margin from the beginning and taking too long to get to it to where you can actually make money on the deal. So again, time is your friend, time is your enemy in this investment and lots of other investments as well. So again, hopefully you guys get the feel for that. Okay, financing for NPLs. I wanted to kind of revisit this a little bit, give you a little bit more on kind of a feel for what the institutional, and when I say institutional, that would be kind of the BlackRock financing. So this is going to be minimum $250,000 loan amounts. So let's break this down a little bit further. Minimum loan amount, in other words, you're buying a portfolio of 5 loans minimum. The actual loan amount that they will lend is $250,000. So in other words, your actual portfolio purchase price is probably going to be somewhere around 325 to 350,000, depending on a couple of factors that we'll talk about on the next slide. It's a 3-year interest-only loan. Interest rates are probably going to be somewhere around in the 8 to 9% range. The debt service is going to be monthly interest-only payments. There's no prepayment penalty because obviously as you take an asset to disposition, if it's deed in lieu of foreclosure, part of those proceeds go back to paying the loan down. So there's a waterfall on how that works that we're not going to talk about today, but just understand that part of the money when you sell an asset goes to reduce the debt on the overall portfolio. Hopefully getting to the point to where the loan is paid off and you either have a loan or you have some kind of cash flow or profits at the end of it. No yield maintenance. Origination fees 1.5 points due at the closing of the loan. That is not included in the loan amount. So you're going to have $250,000 loan, and then like as if you're buying a house, you've got your down payment or your equity, and then whatever costs are involved in getting the loan. LTV, LTC. So let's talk about that, how they figure this out. So on this specific model, the loans are broken out for figuring your maximum loan amount based on whether it's in a non-judicial foreclosure state or judicial foreclosure state. Judicial foreclosure state, being that it takes a little bit longer, sometimes significantly longer, to get through that process than in some of the shorter non-judicial foreclosure states, such as where Scott is in Texas, where it's foreclosure by lethal injection, pretty much done in about 3 hours.
We do everything
some states like
Kings County, New York, and fast execution. Certainly.
That's right. Exactly. Kings County, New York, probably one of the longest foreclosure processes in the country right now, can take 3 to 5 years depending on the situation, and that's Brooklyn, New York, my hometown. So, so the loan to value on non-judicial foreclosure, they'll go up to 75% of either the purchase price, if this is if it's a portfolio purchase, or of market value if it's a portfolio you've owned for over 12 months. So we've got quite a few lenders that are coming into play now that have had these portfolios for a while, and they're looking to recapitalize and to be able to take advantage of new buying opportunities. So they're able to use that in this program to be able to pull cash out to buy the next portfolio. So again, 1 year, if you've owned them for 1 year, you use market value. If you're buying them, you're using your purchase price. Okay, so that's where the loan to cost or loan to value comes in. If it's a judicial foreclosure state, drop it by 10%, a little bit less riskier more riskier for the lenders, so they drop it 10% to 65%. If you have a mix of judicial and non-judicial, that's fine. The loan amount will be balanced by as you factor in 65 and 75, whichever assets. So it doesn't have to be a portfolio of one or the other. They can be mixed together. Hopefully that makes sense.
Basically, just a weighted average across the purchase prices and the asset foreclosure class type.
Right, exactly. Yeah. Minimum FICO, even though these are non-recourse loans, they want to see the sponsor or sponsors have a minimum FICO of 620. 620 is pretty low, so shouldn't be a problem for most people playing in the space. Borrowing entity will create, sponsor will create and now this is something that happens during the underwriting and closing of the loan, a new special purpose entity LLC that will be the actual borrowing entity. So if Mark Gold has a portfolio of 10 loans he's buying, I got my term sheet, we're moving forward, we're getting our BPOs done. I'm going to set up a new special purpose entity that it's never existed, has never had a liability, has never had an asset, so that there's no potential issues for the lender of somebody coming and putting a claim on that LLC. That's the reason that is put together as a special purpose entity, so that it is 100% guaranteed, has no issues or liabilities or any skeletons in the closet that can come afterwards. A question that people ask is, what if I've had an LLC for 3 years, I just haven't done anything with it? Doesn't matter. It has to be a newly formed entity during the time of the closing. Recourse, the loan will be non-recourse, subject to certain standard carve-outs for bad boy acts committed by the borrower. What's a bad boy act? A bad boy act, typically what you're going to see here, the only way that they're going to be able to come after you is if fraud is involved. So in other words, you're buying a portfolio and something happened to where you've perpetrated fraud into the deal, but either by inflating purchase prices or doing something that might come up later. I can't even think of because we're not using BPOs, or because the BPOs are going to be going directly to the lender. I guess it could. You could be getting 10 BPOs, putting them into, into Adobe and changing the values. That would be fraud. So there's lots of different. Now, I'm not saying this to give you guys ideas either. Again, same as on any kind of residential lending. Everything has to be above board. We're dealing with institutions. We're dealing with banks. We're dealing with whatever. So again, eliminating the fraud is a big part of what everybody's trying to do. Servicer lender shall have the right to approve any servicer engaged by the sponsor. Timelines, depending on the deal complexity, allow up to 30 days, but we're getting stuff finished in probably 2 to 3 weeks if they're smaller deals. 30 days if it's larger transactions, 30, 40, 50 property notes in a portfolio. But if it's a typical 5 to 10, should be able to get it done in a couple of 2 to 3 weeks. All right, so that covers most everything. I just wanted to kind of put out one of the things that we do is our note boot camp. We've done about 8 of them to date. Typically, all of them have been, actually not typically, all of them have been in Southern California, LA, Orange County, and San Diego. We're actually taking the boot camp on the road. We're going to be doing one out in New Jersey end of October, and we're doing one more in LA in September. What it is 2 days of intense instruction covering non-performing loan basics. We don't go into marketing. We don't go into fundraising. Some of the things that Scott covers really well in some of his programs. So we don't deal with any of that. We deal with just the basics to get you enough of the knowledge, if you've already got your money, to be able to go out and buy your first note. More than 50% of the people who have attended have bought their first note either during or shortly right after the boot camp. So we're pretty proud about that. And again, it's building that network that I don't think anybody in the business has done better than Scott with his mastermind groups and everything else. This note camp, just amazing ways of connecting people. We do it a little bit differently on a smaller scale, more localized scale. Being where I am in Southern California, using Meetup and everything else, we've got a really good group of local investors that, again, quite frankly, become your next buyer, become your next money partner. And there's something to be said for being in a room with somebody for 2 days and kind of going through we call it Hell Week with them for a couple of days. It's a great way to kind of to bring like-minded people together, to be able to co-invest, and again, build that network that's so important in this business. Again, we call it guaranteed inventory supported network. That's what it's all about. So we're doing our, again, localized New York and New Jersey and LA. We're gonna go through, so the 2 days we go through acquisition and due diligence strategies. Again, all the important thing that you need to know from a fund manager's perspective, financing and how to tap into that a little bit more in detail, and going through the actual workout strategies that, again, guaranteed to get into the game with all the support that you need.
And your guys, the one in LA, where's it going to be at? You're going to be over at Peak's corporate offices, aren't you?
Yeah, we're going to be up at P. We're going to be doing 2 in LA. I'm not sure how the dates are going to play out. One of them will be at Peak's corporate offices. They'll be coming in to help us with the presentation on the workouts. And then we're going to be doing another one at some point in that same kind of similar time frame in the Glendale, Hollywood area. Cool. So, which is, again, LA Valley is pretty big, so we want to kind of separate them out a little bit.
Right. And guys, if you click on the link there, you see the logo down at the right-hand bottom, and click on it, plus there'll be a link at the end of the recording for those that are catching this in the replay. That'll take you directly to the sales page, and if you use the special code NOTECAMP, it'll give you $100 off it. And we got a question here from some people in there. Are spouses included at the $6.99 or the $5.99 price? Yeah,
absolutely. Yeah, and actually the code is Scott100, so the No Camp special is $100 off. And yes, you can bring a spouse. We're going to want to see a marriage certificate and make sure you have rings on. Just kidding. Yeah, so if you bring a business partner, that's a separate person, but spouses absolutely are invited to come free.
Okay, cool.
Okay, so on our page, when you go to note.guru, you'll see the Note Bootcamp. We have a top secret page. It says top secret, and you'll put the Scott100 code in there, and that'll get you the $5.99 price for that.
Mark, it's a good thing not to put top secret on your website so people know where to find it.
Yeah, but they have to have the code. Too much fun. So that's it. That's the presentation. This obviously I'll send the PowerPoint to Scott. He'll post that up in Basecamp. And then again, if you guys aren't already connected with me on Facebook, LinkedIn, or on Meetup, find me on that. Again, we're building a big community online as well. We will try to contribute as much as we can in that. And again, again, it's all about, networking online or in person with like-minded people and helping to do a couple of things: build great independent businesses and help pull the country further out of the toilet that we've been in because of the whole mortgage meltdown crisis. So we're all on the front line of doing that, whether you know that or not. So we feel real strong about helping to pull this out together again.
Yeah, and I think honestly, the note industry is a small niche group still. And I think it's a whole lot different than the fix and flip, the wholesale side, the real estate side. It's a much smaller community. I mean, I still think there's 5,000-6,000 note investors out across the country that are seriously doing it. But it's still a very small market and very warm market, I'd say. A lot of people share resources and network and things like that.
Yeah, it's really weird, and again, you hit that one right on the head. I mean, in the regular traditional real estate side of the business, there's a million licensed realtors literally nationwide. There's a lot of competition, but again, we've got so few, relatively speaking, so few people involved in this business. And when you think about it, we're moving trillions of dollars worth of paper. So when you even if you use your number of 6,000 people, playing in a $1 trillion industry, that leaves a lot of open room where, I'm not worried about you buying a note in Florida. If I'm buying a note in Florida, there's enough out there for us to all be looking at the kind of the same stuff, because everybody's model's a little bit different, and it's going to take that collectively for us to actually do the good that we all want to do, as well as making the profits that we want to make. So again, we all share, a lot of us share, best practices, our secret sauce, so to speak, on some things that, again, to help the next wave come up and do it, because we can't do it ourselves, and we know that.
Yeah, no, exactly.
Yeah.
A couple questions here. Mark, could you go back over the payout on the financing side? So, is this the same thing I've heard where, God, I'm trying to read the question here. It's kind of what I think they're getting at is when you take out the loan and then you're selling assets off, they're asking if a portion is going to go, do they get all the profits back in an individual note sale, or do a portion go back to the principal balance? How does that work as far as the note financing side?
Yeah, so there's a waterfall based on, basically it's 110% of, so if you have a sale, okay, we bought a note for 50,000. I'm going to break it down into a single part of the note.
That'd be great.
So you bought a portfolio of, let's say, 10 notes. One of them we take to foreclosure, we sell it. So the cost basis on that loan was $50,000. And then from that $50,000, there was a portion of it that was allotted to the loan, which was 65 or 75%. We now sell that loan for $100,000. So from 50,000, we sold it for 100. 110% of that sales price is going to go to pay down the loan, and the rest of it is going to go towards the spot, any interest or anything that's accrued on it. So 110% of the balance, of the principal balance allotted to that loan. Then any interest or reserves that are required to eliminate that one, and then the balance goes to the sponsor, because again, the lender knows the sponsor might have expenses, employees, has to earn part also. So part of that is always going to the sponsor as long as you're above that 110% of the allotted amount. Did that make sense?
Sure does. Now, one of the best things, you've got kind of a term sheet that we can throw up there and share with everybody too in Basecamp, correct, Mark? Mm-hmm. Okay, so we'll post that up there. And one of the big things, let's rehash again, that they'll do loans where they're lending up to, or as little as $250,000, right? Correct. 5 loans at least, $250,000?
5 loans, minimum $250,000 loan amount. So again, purchase price $325-ish, around there, depending on judicial, non-judicial.
Guys, it's got some opportunities there for you on that stuff as well. And then Mark, and then Joel Markovitz, I think you guys have heard him on earlier. For those that are catching the replays, he was on yesterday. He'll also be speaking to the Note Boot Camp too with you, talking about some of the servicing. Are you guys working together on some of the loss mitigation stuff and the note work stuff?
Yeah, you'll probably see some of the similar stuff on his presentation. We do work together on that, so they are part of the AssetWorks platform.
Okay. Cool. Yeah. Any other questions? Good stuff. Looking forward to this. It's exciting. I know a lot of you guys are looking at raising private capital, and I know that we talked a little bit about our IRA leads and helping do this stuff, but they've got a great product here for you guys to take advantage of. The best thing I can tell you is get some bids in and start maybe get a 5-6 assets, a pool in, and get them over to Mark to start pricing out, and that'll be the better route as far as getting a bid and cost basis and things like that for. Would you agree with that, Mark?
Yeah, absolutely. And again, I love putting it out like that, Scott. do it, right? You guys are going to be drinking from a fire hose all weekend. The 4-day piece of this. You don't try to immerse yourself and become experts at every single thing. There's a support systems in place that'll pick up a lot of what you don't know, and you quite frankly don't need to know. You should know, but you don't need to become an expert in. Get into your first deal. One of my old presentations, I always start it with Nike's famous saying, just do it.
Yeah.
Whether it's the first loan or first 5 loans for your first portfolio, find it, just start going down that road. Again, there's enough between Scott's resources, my resources, and a bunch of the other great people out here that are going to be speaking to you. We're going to make sure that everything's covered to make sure that you're not making that fatal mistake. So it's all about getting into the game and doing it. You're going to learn as you go, and just use the support systems that are in place to make sure that you're covering your bases.
Amen to that, brother. Amen to that. All right, guys. Well, there is Mark's information, info@note.guru. You can check him out at note.guru as well, or assetworks.us, and that's works spelled W-E-R-X. Great thing is you do not have to spell to be good at the note business.
Absolutely. I pride myself on that, right?
Exactly. All right, Mark. Well, hey, buddy, thanks for taking so much time and to join us here in Note Camp. We got a lot of great comments here from people that join up. Awesome. I'm sure we'll get a lot of feedback from those that are catching us on the replay later on. So have a great week. You have big plans for the rest of the day?
Great job, you guys. This is amazing.
No, go ahead. Sorry.
Yeah, we're going to the beach. It's one of those 85-degree beautiful days out here in Southern California, so we're going to go take advantage of it. You'll probably see me on Facebook later.
Probably so.
Yeah, thanks again, guys. You and Chase, again, great job with this whole Note Camp. This is cutting-edge stuff, and you guys are knocking it out of the park. It's really cool. I've been watching, popping in over the last couple of days. Really cool stuff.
Well, thanks, man. Appreciate it. He's out getting him a fresh cup of water right now. So, all right, guys. We'll see you guys. We'll take a short break, and we'll see you guys on the next episode here in about 15 minutes.